An old woman was crying alone in a hospital corridor. A passing doctor asked if she needed help. She said her grandson had been calling for a nurse all night. No one came. She found him in the morning with the same bandage he had 3 days ago. She changed it herself. She is 74. She did not know how. The hospital had not run out of nurses. It had run out of money. Not because it was empty, it was full. But the company that owned it had been quietly pulling cash out for 11 years. $645 million. The nurses were gone because the money was gone. The money was in a private equity fund in Los Angeles. That fund has 87 employees. It bankrupted the hospitals. Then it bankrupted Joanne. Forever 21. 28,000 people lost their jobs. This week, someone offered to buy that fund for $85 billion. This is where your money goes.
In 2010, Leonard Green bought a majority stake in Prospect Medical Holdings, a chain of 16 hospitals serving some of the most vulnerable communities in America: California, Connecticut, Pennsylvania, Rhode Island, Texas. For 11 years, from 2010 to 2021, Leonard Green controlled Prospect. During that time, the firm made a series of financial moves that a bipartisan Senate committee would later investigate in detail. They extracted $645 million in dividends and preferred stock redemption. $424 million went directly to Leonard Green's investors. The CEO, Sam Lee, took home $128 million personally.
How do you take that much money out of a hospital system? One move in particular tells the story. In 2019, Leonard Green directed Prospect to sell its own hospital buildings and then rent them back. This is called a sale-leaseback. Prospect sold its real estate to a company called Medical Properties Trust for $1.55 billion. That gave them cash to distribute. But now, Prospect owed $100 million a year in rent for buildings it used to own. Imagine you own your house. Someone tells you to sell it, hand them most of the cash, and then pay rent to live in your own home. Every month, forever. That is what happened to these hospitals. While $645 million flowed out, conditions inside the hospitals collapsed. The Senate report found that Leonard Green's primary focus was financial goals, not quality of care. Nurses were laid off. Ambulance drivers were forced to pay for their own gas. Rates of bed sores, sepsis, and hospital-acquired infections climbed to some of the worst in the country. Doctors were not paid. Pensions were not funded.
The Pennsylvania Attorney General sued Leonard Green and the founders to claw back approximately $650 million. In Connecticut, one hospital that once had 102 beds now only offers an emergency room. In Texas, facilities were permanently closed. Over 1,000 employees were laid off in a single state. In April 2025, Crozer Health, hospitals Leonard Green had previously acquired in the Philadelphia suburbs, was shut down permanently. No buyer was found. Leonard Green sold its stake in Prospect in 2021. Prospect filed for bankruptcy in January 2025. Leonard Green kept the money. But hospitals were not the only things Leonard Green was buying.
While Leonard Green was extracting hundreds of millions from hospitals, it was running the same playbook on some of the most familiar retail brands in America. Joanne Fabrics, the craft store with locations in nearly every American suburb. Leonard Green owned it. In March 2024, Joanne filed for bankruptcy. It looked like it might survive. By January 2025, Joanne filed again, and this time
announced it would close every single store and liquidate completely. 19,000 employees lost their jobs. Forever 21, the fast fashion chain that defined a generation of mall shopping. Leonard Green was part of the ownership consortium through Authentic Brands Group. In March 2026, Forever 21 filed for bankruptcy and announced the closure of all 355 domestic stores. 9,200 employees were laid off. The company carried $1.5 billion in debt. The Container Store, the organizing retailer with a loyal customer base. Leonard Green invested. The Container Store filed for bankruptcy in December 2024. 3 beloved brands. The same owner, the same outcome. Debt loaded onto the company, cash extracted, bankruptcy. And in March 2025, while Joann's 19,000 employees were filing for unemployment, Leonard Green won Private Equity Hub's Comprehensive Trade of the Year Award for selling a building products company called SRS to Home Depot for $18.25 billion. The award came with applause. The bankruptcies came with silence. You would think that a record like this would have consequences. What happened instead is the opposite.
On July 28, 2026, the Financial Times reported that Ares Management, a publicly traded firm managing $644 billion, has been in talks to acquire Leonard Green and Partners. Leonard Green manages $85 billion. Ares manages $644, but only $25 billion of that is in private equity. Buying Leonard Green would more than quadruple its PE business overnight. For Leonard Green's founders, Sokoloff and Dan Hockel, this is not just a deal. This is the exit. Both have been at the firm for more than 30 years. Neither has publicly discussed secession. An acquisition by Ares gives them liquidity, legacy, and a transition on their terms.
John Danhockle is worth $1.7 billion. Jonathan Sokoloff is worth at least $150 million. These are the men who directed the financial strategy that led to the extraction of $645 million from hospitals. And their reward is not a lawsuit. It is not a regulatory action. It is an $85 billion acquisition offer. This is not a failure of the system. This is the system working exactly as it was designed. Private equity firms are not penalized for bankrupting portfolio companies. There is no mechanism to claw back fees and dividends after a bankruptcy. The founders took the money. The companies collapsed. And the market said, "We want to buy what you built." Leonard Green is not alone. This week, a report tracking private equity layoffs in 2026 found that over 100 PE-backed companies have conducted mass layoffs since January. 34% were in manufacturing. Private equity-backed companies accounted for 70% of the largest bankruptcies in 2025. And yet, the industry manages trillions. The question is not whether Leonard Green did this. The evidence is public. The question is what it means.
Leonard Green and Partners has 87 employees. The companies it owned employed tens of thousands. The math is simple. The consequences are not. If you have a 401k or a pension, there is a meaningful chance that your retirement fund is an investor in a private equity firm. Not Leonard Green specifically, but a firm that operates the same way. Your savings are the capital that funds leveraged buyouts. When a PE firm extracts a dividend from a hospital chain, part of that dividend may flow into your retirement account. You are in this system, whether you chose to be or not. 19,000 jobs at Joann, 9,200 at Forever 21, 1,000 in Texas, Hospitals closed in Pennsylvania and Connecticut. Nurses unpaid. Pensions unfunded. Ambulance drivers buying their own gas. And at the end of it, an $85 billion acquisition, an award for Trade of the Year, and 2 men in a single office in Los Angeles worth nearly $2 billion combined. If Ayers completes this acquisition, it will be the clearest signal yet that the market does not punish this behavior. It rewards it. If you want to understand what that means for the next company on the list, this is the channel. Subscribe. The next deal is already happening. 87 employees, 28,000 jobs. One question: is this how the system should work? Comments.